Now, the stock that a business has, there can be many things that can happen to it. For example, it may get damaged, stolen, or it could even become obsolete because it has not been used for a fairly long period. In such a situation, you may have that the stock itself by value has become worthless. I mean, something stolen or lost is become worthless, and even those which are damaged or for example have become obsolete or now cannot be used, may not realize its cost price may be much lesser. So there is a something called a realizable value. So the stocks which are worthless or worth less than their original cost should be written down to their values, either 0 if it is worthless or to the net realizable value if it is less than the original cost. Remember, this is very important point that we have to make. It is not necessary that you should have actually sold or actually thrown off the material. It is once you have estimated that certain amount of goods in the whole stock that you hold is either worthless or you will realize much less than what the cost is, you should account for it by writing it down, which is what the prudence principle dictates for us to do. I hope this point is clear. It is not necessary that goods have to be thrown away or sold for you to recognize that they should be valued at only the price at which they are either realized or if they are worthless at 0, because that is how you will be able to ensure that the position that you are stating in your accounts is correct. It is not necessary that it should be actually sold or thrown out. So once that assessment has been made, the necessary accounting entries to do that should be passed. Now let's look at this in Anil's context of his business. Suppose 200 units were damaged and he could sell them, he assesses that at only at say 4,000 rupees. So now what happens, his closing stock was 500 rupees, which was at rupees 30,000. The cost of 200 units would therefore be 10,000 rupees, and the balance cost of 300 units is 20,000 rupees. So what happens, the net realizable value is of this 200 units which actually cost him 10,000 rupees is only 4,000 rupees. So what is the closing stock value, in which case it should be reckoned at only 24,000 rupees. As I said before, it is not necessary for Anil to actually sell it off at 4,000 rupees or for that matter reckon that he has to throw it or whatever, but the point is that once he has assessed that it will not fetch him more than this amount, he has to recognize that fact and account for it accordingly and not wait till he actually sells that at the lower price that he is estimating. So the trading account will then factor for that in. All the other items remain the same, but the closing stock figure now instead of 30 is showing 24,000 rupees, and therefore we have a situation where the cost of sales has gone up and the profit has accordingly come down. This is a prudence principle in action, and closing stock should be reckoned in that fashion in case there is damaged or obsolete or stock that cannot be used or lost or stolen. So having looked at the concept of cost of sales and cost of goods sold, the next point is how do we know how much physical stock is there with us? I mean, you need to take a count, only then you will know that certain amount of stock is there. Although stocks are being issued for production regularly or for sales regularly from the warehouse or the store, so you need to take stock of things from time to time. The physical count has to be taken from time to time to understand what is the actual physical count that is there, and more importantly, when your accounting period is coming to an end, this becomes more essential because you need to present your financial statements, and therefore you probably need to freeze your activity, which is not possible when you are running a business. There are two ways you can actually handle this. One, in fact, you must have heard that when it is March 31st or around that, for 3-4 days or 5 days, all businesses stop all activities just to take the stock count. Now this is something that they do in practice also, find it easier because they will be able to know exactly what is happening. In some businesses where this may not be possible, while the stock taking is happening or the count is happening, simultaneously a record is kept of those items which are going out and coming in, so that that adjustment can be done during the stock at the end of the stock take, and therefore the final figure can be arrived at. There is also, in more complex businesses, a method what is known as continuous stock taking or perpetual stock taking, where the records for what is coming in and going out is maintained on a continuous basis, and say in a particular day some 5 or 10 items are selected, and the actual, as per their record, and the actual stock are tallied. So on a daily basis, this kind of an exercise is done in many organizations which are, large organizations, where this freezing and during the what do you call a stock take alone, the records cannot be kept. It has to be a continuous process, because the amount, the variety of stocks they hold, the size of stocks they hold, all that may determine that they do it on a continuous basis. Okay, let's now, whatever we have sort of looked at now, let's look at a small video clipping that will give you a little more insight into it.
A merchandising company has inventory, and what is unique about a merchandising company is that inventory is purchased in ready-to-sell condition. Examples of merchandisers are Walmart, Macy's, Home Depot, and a car dealership. We can also have a merchandiser that is just a simple produce stand. All of these companies have one thing in common: they purchase their inventory in ready-to-sell condition. Manufacturing companies, on the other hand, build the inventory. They buy component parts, assemble those parts into an item that they sell to customers. Examples of manufacturers are General Motors, IBM, and Sony. All of these businesses buy component parts, put them together, and build their inventory that they sell to their customers. The accounting associated with manufacturing companies is far too complicated for us to address in this course. Therefore, we need to understand what a manufacturing company is, but we will not be studying accounting for manufacturing companies' inventory during this course. The economic events related to inventory that we will study, and remember we'll study it only for merchandising companies, are purchasing inventory from a supplier, receiving a discount from the supplier, paying for shipping from the supplier, returning inventory to the supplier, paying the supplier for inventory. Then we will study selling inventory to the customer, paying for shipping to the customer, giving a discount to the customer, and receiving inventory returned from the customer, as well as receiving a payment from the customer. Finally, we have something called shrinkage that we'll study at the end. There are two different types of accounting systems that we can use for inventory. The first is perpetual. In a perpetual system, the inventory account is updated whenever inventory is purchased and when inventory is sold. A perpetual system provides more detailed information and is generally more costly than the alternative system. It is the preferred method because it does give more information, but because it is more costly, it may not be cost effective in all businesses. Examples of businesses that will most likely use a perpetual system would be any business such as a diamond or jewelry broker that has very expensive inventory items. In addition, even if the items aren't expensive, if there's a computerized scanning system, the company may be able to use the more advantageous perpetual system. The alternative to the perpetual system is the periodic system. The periodic system only updates the inventory account at the end of each accounting period. Accordingly, it provides less information than a perpetual system. However, it's useful when keeping detailed records on specific items sold is not cost effective. An example of a business that would use a periodic system might be a street vendor. A street vendor has many different low-cost items, but does not have a computerized accounting system to keep detailed records as to which specific item is sold.